So we received the U.S. Bureau of Labor and Statistics employment report, and it came back stronger than a lot of people were expecting. So what does that mean for us? Well, if you're buying or selling a home or thinking about buying or selling a home in the next 6 or 12 months, I'm going to tell you what to expect based on the report we got back in December. The December report shows that the U.S. added 256,000 jobs in December. Now, some of those are going to be seasonal, but regardless, the unemployment rate actually went down to 4.1%. That was unexpected, and it signifies a stable and even growing economy. When unemployment is down, the economy is stronger. And the concern is we might have continued inflation. So the feds look for labor statistics as a major indicator of whether or not they're going to raise, lower, or maintain the current rates. And right now, the labor report points towards holding the rates for at least the next quarter or so. Now, on the flip side of that, the labor force participation rate remained unchanged. It's right around 62%. So what does that mean? Well, it means that the job sectors are not pulling in new workers. So if the participation rate remains stable, it means we can continue more the same. And it's an indicator that we're more likely, maybe we won't see any major adjustments and we're just going to hold steady, less likely to raise rates. In 2024, we saw the addition of about 2.4 million jobs over the course of the year. Now, that's less than the post-COVID boom when we saw more than that, but it's greater than 2019 when we had about 2 million jobs. So between 2019 and 2024, that number indicates a steadily and sustainable growing economy, which is good. What we don't want is it to explode, and then we need to raise rates to tamper down the inflation. And we don't want it to crater where we have rates drop down to 2.5% or 3%, because that signifies a much bigger problem in the overall economy. Frankly, I think we lucked out that we haven't hit a major recession, but we're still going to see. Right now, we're looking really good. So following the employment report, we saw Treasury yields go up. We saw the power of the dollar go up, and we saw the S&P come down a little bit. So what does that signal? Well, it signals that investors and analysts anticipate a stronger economy coming up, which may affect interest rates going up to tamp down the growth. The Fed's goal is to create a sustainable and steady economic growth that we can forecast to, and we can make sure that we have a healthy economy. When they raise interest rates, they're pushing down the economy and they want it to slow down. When they lower interest rates, they're trying to give it some fuel to the fire and spur economic growth. What we always want is a steady, solid, sustainable growth rate. And that's why they set the inflation rate around 2.1, 2.4%. That is a solid, sustainable rate. So in summary, the report shows that we have a strong economy right now. We're in pretty good shape, and we have a resilient job market. What does that mean for those looking to buy or sell real estate in the next year or so? It means that we're unlikely to see a major rate drop. A lot of analysts were anticipating a rate drop in Q1 and Q2. A lot of them are saying now maybe a quarter point in mid-year. So right now, expectations are that we're going to pretty much be living in this realm of interest rates right now and mortgage rates. So waiting to buy a home when interest rates are lower is probably not going to serve you well, because a resilient economy and workforce means that we're going to have continued steady appreciation. And if you're waiting for a year from now, when rates go down, your prices are going to go up. It's all good news economically and long term, but just start thinking about the fact that this is where we want interest rates where they are now. A little bit lower, 5.5%, 6% would be great. 6%, 6.5%, 6 3/4. That's okay. That's manageable, and it's what we can live with, and we can get it done. So keep that in mind.